With the lockdown lifted here, there is quite some optimism that we are likely to get out of a bad or tough economic spot here in Uganda, with, of course, improved economic activity. Now, experts are telling us broadly on the African continent, we are likely to see growth of 3.2%, mainly driven by huge investment in infrastructure, favorable weather conditions, and of course, the rollout of the vaccine programs. Now, we're picking the minds of an expert from Absa Bank Uganda, trying to understand or put into context what this means and indeed how the continent is likely to forge a way forward.
World Health Organization has already confirmed that the third wave of the coronavirus sickness is the COVID-19 is hitting the majority of African countries. I think for Uganda, this is basically the second wave. We're slightly below the curve or behind the curve. But like what happened last year when infections rose and the first lockdown came, activity was stopped and broken down, and as a result, growth slowed down. At that time, there were no vaccines, so all that was required was, as a safe measure, close up and make sure that spread reduces before you open up and economic activity resumes. Globally, the global average for vaccine rollout is at 28.5 doses per 100 people. That's 28.5%. But for sub-Saharan Africa, it's at about 1.5 doses per 100. Uganda at 1.1, an estimated 1.1 doses given, is at an average of 1.3%, which is still below the threshold. Why are these numbers important? It's important because when people get severe infections and death is when the lockdowns and the restrictions are heightened and increased. When those happen is when the economy or the country is closed down. When the country is closed down is when the economy takes a dip. So if one thing flows into another. Therefore, if we have more people vaccinated and severe infections becoming less, then it does that the more people we can have vaccinated sooner, the quicker we can open up the economy. The quicker we can open up the economy, the more economic activity picks up and the more growth returns to the country. Inflation rates for June came in at about 2%, helped really by persistent food deflation. Basically, there's a lot of food, and food forms a significant part of the inflation basket, and because that was low, inflation basically was low. In the near term, we think that the effects of the lockdown are going to add or maintain that status quo. However, as we move forward and as we go towards the end of the year, we expect inflation may edge up slightly. Why? Because if there's been a lot of spend on health, if transport costs, for example, have increased, and also base effects from the way inflation was measured last year and this year, it means that now if you compare in the future, there's a huge possibility that inflation would edge up. Our economists basically still think that inflation may end the year at about 4.5% for the end of the year. Talking about the currency, it's quite interesting actually. People would think of it as an anomaly. If you think about the rest of Africa, last year we saw huge amounts of volatility in the various currencies. The kwacha, the Kenya shilling, the South African rand, the Nigerian naira, all those had a lot of volatility. Last year for Uganda was very interesting. When the lockdown came at the beginning of the lockdown in March, we saw a spike in the currency. It depreciated very fast and quickly corrected and came down. And since then, it has traded 3,600 and below. This year is even more special. I mean, it has actually strengthened this year, meaning that it is lower, the dollar to the shilling is lower than where it was at the beginning of the year. What has helped it? We have seen a lot of portfolio flows, meaning investors bringing money to invest our treasury bills and bonds market. And what has helped that confidence also is the stability of the currency. You know, it's a chicken and egg. The investors came, brought more dollars, the dollars strengthened the currency, and because the currency is strong and stable, more investors are looking and they're thinking, look, I think it's good to invest. Obviously, there's a benefit we have had from the exports in coffee, diaspora flows. So monetary policy affects inflation and economic activity or the economy generally with a lag. It is not immediate. Basically, the CBR or the central bank rate is basically supposed to be an indicator and supposed to help drive certain actions in terms of increasing lending to the private sector and things like that. But it doesn't happen immediately. The cut happened about a month or so ago, and the effect of that is going to still yet to be seen. It's the right move considering that inflation was low, considering that the outlook also for inflation is still below the 5% mark. Is that benefiting yet? Right now, the fact that we have a lockdown has affected us negatively because if there is depressed demand, if there's depressed economic activity, even the people who run businesses want to be in a hurry to do what? To borrow, because where are they going to borrow to put the money? They cannot import from China. If the malls and arcades are closed, what does that mean? It means that you're going to borrow money. If you borrow money now, you have nowhere to put it, so you hold off on borrowing.
There's no doubt agriculture is the backbone of this country. Challenge, though, is that it's largely dominated by smallholder farmers. Now, for someone to transform this sector and the people that sit within it, there has to be organization or restructuring of the people, that is smallholder farmers, that sit within it. Today, there are several programs that have been initiated to touch that particular area, and we explore one of those. Agro-industrialization is the economic pet phrase today across the public and private sector in Uganda. But for the vast arable fields of northern Uganda that must shake off the history of a war zone, developing unintegrated forward and backward linkages remain critical. In October 2020, the Uganda Development Corporation, UDC, in partnership with the private sector actor, Horial Investment Holdings Company Limited, had the Atiak Sugar Factory commissioned.
In Atiak, specifically, it's a very unique model. The idea was to establish a factory. Then the next question was, where do we get the raw materials from? So through NADS, government of Uganda agreed to support farmers to grow cane to supply the factory. There's a small nucleus farm for the factory, but most of the sugarcane grown both on in Atiak, in Amuru side, and in Lamo side, purely for the communities through cooperatives.
The joint venture between government and the private sector in this project seeks to enhance the potential of northern region in as far as the quest for agro-industrialization is concerned. UDC holds 40% stake in the Atiak Sugar Factory, with the remaining 60% held by the private sector actor. However, inadequate supply of sugarcane still remains a challenge, making it hard for the plant to operate at full capacity. With challenges of the required sugarcane supply raging on, rerouting abundant sugarcane hitherto without demand from sugar millers in Busoga region has been the option.
The people from Busoga were exporting cane to eastern Kenya for processing, but that is no longer available as well. So that meant that the farmers in Busoga had a lot of cane. It is estimated, total production of cane is estimated at 7 million tons per year. And total crushing capacity is estimated about 4 million tons, meaning that we could be having close to 3 million tons in excess of total crushing capacity.
Atiak Sugar Factory now believes that its outgrower scheme within Amuru and Lamore district in northern Uganda will effectively contribute some supply in addition to the 3 million excess tons of sugarcane from farmers in Busoga.
The factory is running very, very well, but cost of running it is very, very high because of the low capacity of cane supply. At the moment, I can say that we are producing from the time we started, which is almost like 8 months, we have only crushed 124,000 tons of cane. And from that, we were supposed to crush every month 60,000 tons.
Observers argue that the 15,000 strong outgrowers currently being developed within the Acholi sub-region as an integral supply chain could have ripple effects within the economy of the north.
It is going to be a very big transformation in the whole area. These are areas where I used to say it was a battlefields, and we have changed the battlefields into green fields. There is a lot of peace, because peace came. Yes, I should thank the government. The peace came, but you see, with economics, it becomes total peace because everybody will want to look after where they are getting their money.
With 3,500 direct employees today, an estimated 25,000 of diverse outgrower farmers are the ripple effects on this project. As Uganda eyes validation in its endeavor to transform agriculture for the benefit of both farmers and the wider economy, it has become clear that the real transformation requires participation of all regions of the country, and Atiak Sugar Factory based in northern Uganda is a good step in the right direction. Well, that brings us to the first segment of this show. Man and Markets continues after this break.